discuss the legal aspects of business. A contract is a legal or lawful agreement between two or more people or organizations. It is enforceable by law, which means that if one party fails to do what was agreed, the other party may take legal action. A contract must include three parts: two or more parties, a promise, and something valuable to exchange, also called consideration. So, consideration is something of value exchanged between the parties. It might be money, goods, services, labor, or some other type of benefit. For example, in an employment contract, the two parties will be the employer and the employee. The promise is that the employee promises to provide labor services. The valuable benefit or consideration is that the employee receives wages. In a sales contract, the two parties would be the buyer and the seller. The promise would be that the seller promises to provide a good or service, and our consideration is that the buyer pays money for the good or service. Contracts are important as they clearly set out what each party is expected to do. This reduces confusion, prevents unfair behavior, and protects the parties if something goes wrong. For example, an employee may fail to work the proper hours or may not perform the work to the required standard. Similarly, a seller may not provide services or goods of the correct quality, and may fail to deliver on time. A contract helps to show what was agreed and what can be done if one party does not fulfill the agreement. Terms of a contract. So the terms are the conditions or promises in a contract that must be fulfilled. Examples of terms include the number of hours an employee must work each week, the date by which the goods might be delivered, penalties for late delivery or non-payment, and the rate of pay per hour. Contracts can be either oral or written. So in oral contracts, they are made by spoken agreement. It can still be legally binding, but it is also harder to prove because there is no clearly written out evidence. In a written contract now, that one is recorded on paper or electronically. This is easier to prove because the terms are clearly stated. We also have implied contracts, where a contract might be implied based on conduct, meaning that a person's actions show that an agreement exists even if it was not formally written or spoken. For example, if a person takes goods to a cashier and pays for them, the behavior implies a contract of sale. Now we have the conditions of a contract. A condition of a contract is an important requirement that must be followed. General conditions apply to many contracts, while specific conditions apply to a particular agreement. For example, a general condition may be that payment must be made, but a specific condition will be that payment should be made at a specific date, for example, within 30 days. Another specific condition might be that the goods should be supplied in a particular color, size, or quality. For example, if a mechanic agrees to repair a fault in your car to a certain standard, he's also supplying specific parts and completing the work within a certain time. These are the conditions of the contract. If anyone fails to meet the agreed terms, the customer may be able to take legal action. Now let's identify the different types of contracts. So business contracts fall into different categories depending on the type of agreement. We have a supply of goods. So here is where a seller transfers or agrees to transfer goods to a buyer for a price. The transfer of ownership is important. For example, a shop sells a school bag to a student. The shop transfers ownership of the bag to the student, and the student pays the price. Another type of contract would be supply of goods on credit. Goods are bought now but paid for later, usually in installments. There are rules dealing with credit transactions. For example, you might buy furniture on credit and pay monthly installments until the full amount is paid. Another type of contract is supply of work and materials. A supplier or contractor might provide both the materials and labor. For example, a mechanic might fix a vehicle as well as supply the replacement parts. You have also contract of bailment, which is where the owner of the goods temporarily gives possession of the goods to another person. Example, a person leaves their clothes at the dry cleaner. The dry cleaner temporarily has possession of the clothes, but the customer still owns them. We also have an employment contract which sets out the terms between employers and employees. For example, a teacher is hired by a school to teach classes for a monthly salary. Then we also have contract of agency. One person or organization employs an agent to act on their behalf. A booking agent arranges performances for a singer. Contract concerning land includes leasing, mortgaging, or selling land. Financial services contract like loans, insurance, and financial agreements. Now, the purpose of a contract. So, the purpose of a contract is to officially establish the agreement made by the parties and to fix their rights and duties. For example, if a musician agrees to perform at a concert, the contract might state things like the date of the performance, the amount to be paid, the duties of the artist, and the duties of the booking agent. We also have bilateral contract, which is a contract between two parties. For example, a booking agent promises to pay a musician and the musician promises to perform at a concert. We also have simple contracts, which are legally binding but not made under seal. So it does not require the formal signing, sealing, and delivery used in specialty contracts. Simple contracts are common and may be written, oral, or implied by conduct. Three key elements of the simple contract should be legality, so it must be in accordance with the law. It must have an offer, so one party makes a promise according to the terms, and there should be an acceptance where the other party agrees to the terms. An offer is just a proposal made by one party to another party showing willingness to enter into a legal agreement. For example, a seller offers to sell a phone for $1,000. Acceptance is the act of agreeing to the offer. So, the example, the buyer agrees to buy the phone for $1,000. Specialty contracts. A specialty contract is a contract made under seal. It is more formal and serious than a simple contract. Specialty contracts are usually written or printed, signed, sealed, and delivered. Examples would be sale of land, sale of property, mortgages, hire purchase agreements. Under seal means a legal document with seal or formal mark showing that it is binding. The phrase signed, sealed, and delivered means that the contract has been properly executed. Now we also have contracts of record, which are a special type of contract connected to court orders. The main feature is that the contract has been declared by a court of law and entered into the court's records. It provides conclusive proof of the contract. Describe the characteristics of a simple contract. For a simple contract to be enforceable in court, it must satisfy certain requirements. The main characteristics of a simple contract are offer and acceptance, competence of the parties, intention to create legal relations, consideration. A simple contract begins with an offer made by one party and acceptance of that offer by the other party. The person making the offer is called the offerer, and the person receiving the offer is called the offeree. For example, the celebrity chef who agrees to provide food at a wedding for a fixed price. The agreement is written on paper and includes the services to be provided, the breakdown of the cost, the total price. The person requesting the food might be the offerer if they offer to pay a certain price, and the chef will be the offeree if they accept the offer and agree to provide the food. Some rules about offer and acceptance. For an offer to be valid, it must be communicated in an acceptable way, such as by post, telephone, or fax. It must clearly show that it is an offer. It must not simply be an invitation to provide information. It must be accepted in the way stated by the offerer. It must be accepted within the time frame. A counteroffer happens when the offeree does not fully accept the original offer but changes the terms. A seller offers to sell a phone for $1,000. The buyer says, "I will buy it for $800." This is not an acceptance, it is a counteroffer. The counteroffer cancels the original offer. Competence of the parties. For a contract to be enforceable, the parties must be legally competent. This means that they must be adults or have reached the age of maturity, be of sound mind, understand the nature of the contract, not be affected by alcohol, drugs, or mental illness, and not be under duress. A minor is usually not able to enter into certain contracts. For example, you cannot enter into a cell phone contract. An adult must enter into that contract for you. Duress means forcing or pressuring someone to enter into a contract against their will. If someone is under duress, they are not truly competent to enter into the contract agreement, and it will be invalid. For a contract to be valid, the parties must intend to create a legally binding agreement. This means both parties understand that their agreement can be enforced by law. In social or family situations, the law usually assumes that the parties do not intend to create legal relations. If you agree to meet someone for coffee and fail to attend, the person cannot sue you for breach of contract because that is a social agreement, not a legal contract. In business situations, the law usually assumes that the parties do intend to create legal relations. So if a buyer agrees to pay a seller a certain amount on a certain date, this shows intention to create legal relations. Consideration is the exchange of something valuable between the parties. So it might be like money, goods, services, labor, and a promise. For a simple contract to be valid, each party must usually give or promise something of value. Executed consideration means that exchange happens immediately after the contract becomes valid. For example, a customer pays for a haircut and receives the haircut immediately. Executory consideration means that the exchange will happen later. For example, a customer agrees today to pay a contractor next week after the work is completed. Bilateral agreement occurs when both parties exchange promises with each other. Jones agrees to pay Patel's house and Patel agrees to fix Jones's plumbing. Each person's promise is consideration for the other. Unilateral agreement occurs when one party makes a promise in exchange for the other party's performance. Rules governing consideration now. Past consideration is usually not valid. Consideration must be sufficient. Consideration does not need to be equal in value. The parties must agree that the exchange is acceptable. Past consideration means anything that was done before the contract was made. This is usually not valid consideration. If someone gives you $5 after you helped them last week, there was no agreement beforehand, this may not be valid consideration. Consideration must have value, but it does not have to be equal in value. So a person might sell an item worth $100 for $50 if both parties agree to that. So this is an example of a simple contract here. You have all the terms of the contracts, the date, and it is signed by both parties. So many businesses use standard contracts. A standard contract contains fixed terms already prepared by the business. The details may simply need to be completed, like the names and address, start date, end date, fee, services to be provided. So some examples would be a construction firm agreeing to build a house or a public relations firm agreeing to represent a client. The characteristics of a specialty contract. So a specialty contract is more formal than a simple contract. It is considered more serious and official because it is made under seal. Features of a specialty contract. A specialty contract is usually written or printed, signed by all parties, sealed, delivered, and it often involves large sums of money, major responsibilities, serious obligations. Why specialty contracts are important? Because specialty contracts are formal, courts usually treat them as very clear and serious agreements. This makes them difficult to avoid or deny. For example, a recording artist. A recording artist and his manager receive a contract from a music company. They sign the contract and place it in a sealed envelope. They send it back by courier with a signed receipt. Once a contract is signed, sealed, and delivered, it becomes a specialty contract. So an offer is a statement of terms made by one party. If the offeree accepts the offeree is willing to agree to the terms. 3 components of an agreement. The offerer makes an offer. The agreement is reached. The offeree accepts the offer. So when these 3 elements are present, there is a firm basis for a contract. Invitation to treat. An invitation to treat is not an offer. It is an invitation for someone else to make an offer. Example, goods displayed in a shop window are usually an invitation to treat, not an offer. This means a shop is inviting customers to make an offer to buy the goods. The shop may then accept or reject the offer. Case law is a law based on previous court judgments. Case law is important because past decisions set examples or precedents for future cases. A precedent is a legal example that judges may follow when deciding later cases. Acceptance happens when the offeree agrees to the offer. Acceptance must usually take place while the offer is still open. Acceptance must also be communicated to the offerer. Some rules of acceptance. Acceptance can only be made by the person to whom the offer was given. It cannot be made by someone else. Acceptance must be absolute and qualified. This means that the offeree must accept the exact terms. If the offeree changes the terms, this becomes a counter offer, not acceptance. Acceptance must be communicated to the offerer. So it must be communicated via spoken words, written words, or conduct. Acceptance is formed when received. The contract is usually formed at the time and place where the offerer receives the acceptance. Postal rule. If acceptance is sent by post, the contract is formed when the letter is posted, even if it is delayed or lost. Acceptance must follow the method stated in the offer. If the offer says acceptance must be made in writing, then the offeree should accept in writing. Oral and written acceptance. Offer and acceptance may be made verbally or in writing. A verbal contract can be binding once an offer has been accepted. However, it is more difficult to prove because people may later disagree about what was said. It is usually better to create a written contract because written terms provide evidence. So, a contract is usually continues until the parties have fulfilled their responsibilities. But there is also discharge of a contract, which means that the obligations under the contract have ended. So once a contract is discharged, the contract comes to an end, the rights and obligations of the parties no longer apply. So we have termination of a contract means the contract is ended. Most contracts are completed and then discharged, but some contracts may be terminated before completion. So it might be terminated due to performance. This is the most common way. It happens when both parties fulfill their obligations. There are different levels of performance. You have complete performance, so this occurs when every term and warranty has been fulfilled. There's also substantial performance when most have been fulfilled. The court may allow one or both parties to claim for minor details that were not completed. The conditions must be met, but warranties may not always have been met by the court to decide if substantial performance occurred. Partial performance occurs when one party accepts part of the performance of the other party. A warranty is a guarantee about performance or the doing of a certain thing. A term is any provision forming part of a contract. Each term creates a contractual obligation. Discharge by breach of contract occurs when a party fails to complete its part of the contract. It might either be anticipatory breach or actual breach. Anticipatory breach happens when one party declares before the due date that it will not fulfill its obligations. The innocent party does not have to wait until the date of performance. The innocent party may sue immediately. Actual breach happens when one party fails to fulfill its obligations when performance is due. This may happen when the terms are only partially met, an important part of the contract is not fulfilled, the breach affects a vital part of the agreement, and the innocent party must show that the breach affects a vital part of the contract. Remedies for breach of contract. When a breach occurs, the court may provide remedies. Damages are money paid to compensate the innocent party for financial loss. Rescission means unmaking the contract, so the parties are returned as far back as possible before making the contract. Specific performance means the court orders the breaching party to carry out the duties promised in the contract. Injunction is a court order stopping a party from doing something. Discharge by agreement. The parties might just agree to end the contract. Termination by agreement and consideration. A contract may be terminated by agreement, but the agreement must include consideration. So if neither party has fulfilled their side of the original contract, it is easy to end it because each party gives up rights. Waiving means to voluntarily surrender a right or privilege. Frustration occurs when it becomes impossible to perform the contract through no fault of either party. Lapse of time. So a contract may be discharged if it is not enforced within a specific time period. This period is called the period of limitation. A contract may be discharged if one party dies, especially when the contract depends on personal service. Now let's apply the principles of a simple contract to cases. Damages. Money awarded by the court as compensation for loss or injury. A person who suffers loss because of breach of contract may claim damages. The purpose of damages is to place the insured party in the position they would have been in if the contract had been properly performed. Liquidated damages are damages agreed in advance by the parties when the contract is made. These damages are included in the contract and state how much it will be paid if the contract is broken. Unliquidated chain damages are not agreed beforehand. The court decides the amount of compensation after considering the loss suffered. Penalty clause states the parties will suffer a penalty, usually a financial loss, if certain terms are not followed. Businesses must document all of their processes as well as transactions to keep proper records. So documents are important for purchases, sales, taxes, legal disputes, accounting records, checking and verifying transactions. Reasons for keeping business documents. So to keep accurate documents, businesses need records to measure money flowing in and out during a period of time. To keep records with customers and suppliers, statements of account show transactions and payments made with specific customers or suppliers. To record transactions systematically, documents help businesses record transactions in an organized way so that they can be checked later. To calculate and document taxes, documents are needed so that sales and purchase taxes can be calculated and recorded. To support audits, records must be checked and verified through audits. An audit is an official inspection of an individual's firm's or firm's accounts. An internal audit is carried out by the company employee. An external audit is carried out by an independent qualified accountant. Movement of business documents. So there's a series of documents used by buyers and sellers in business transactions. The process often follows this order: inquiry, quotation and order form, order, advance note, delivery note, goods and invoice, credit note or debit note, statement of account, payments. So we have an inquiry. This is the request by a potential buyer for information about goods and services. It might ask about prices, delivery dates, discounts, terms of supply. Price list is the list of goods and prices. A quotation tells the buyer what goods are available, the price, the terms of the transaction. The order form is filled out by the buyer to show what goods are required, the quantity, price, delivery details. The advice note is a document sent by the seller to advise the buyer when goods will be supplied, in what quantities and at what prices. Delivery note is sent with the goods. It lists the items supplied and may include other details. An invoice may be packed with the goods or sent later. It shows all the goods supplies, the prices, the amount owed, the payment terms. A credit note is sent by the seller to reduce the amount owed on an invoice. A credit note may be issued when goods are damaged in transit, goods are missing, the buyer was overcharged. A debit note is sent by the seller to show additional money owed. It might be issued when the buyer was undercharged, there was an error in calculating the amounts due, or extra charges must be added. A statement of account is sent at the end of a trading period. It lists all transactions and payments made during that time, such as 1 month. So businesses may use documents for different purposes, such as pro forma invoices, purchase requisites, statements of accounts, stock cards. A pro forma invoice, sometimes called a sales invoice, is a document sent by the supplier to a buyer. It establishes an obligation on the buyer to pay. It also verifies the agreement between buyer and seller and forms the basis of a contract. Why several copies of an invoice may be made. Several copies may be made for different purposes. One may be sent before goods arrive so the buyer knows what to expect. One may be packed with the goods so the delivery can be checked. One may be sent after delivery as a formal bill requesting payment. One may be kept by the seller for accounting records. An invoice should include the date the invoice was created, the date payment was expected, names and addresses of customer and supplier, contact names of the vendor and purchaser, description of items purchased, prices and quantities, sales tax, discounts, terms of payment, total amount owed, invoice number, purchaser's order number. This is an example of a pro forma invoice. Now, a vendor is a supplier of goods and services. The term net means no discount is included. Full price net means the full price must be paid without discount. For example, Tobago Clothing Supplies is asked to supply Island Carnival Productions with 30 male dance costumes at $25 each, 20 female carnival costumes at $50 each, 30 children's costumes at $15 each. The full net price, 10% cash discount if payment is made within 1 month. Invoice sent on the 15th of May, 2019. Okay. Purchase requisitions is used as a department within a business to request supplies. It is an official internal order form. Examples of supplies include stationery, paper, office equipment, materials. Purpose of this is to show which department requested the purchase, which department should be charged, what goods or services are needed, who authorized the request, who received the goods. Information on a purchase requisition. It includes the vendor, the purchase order purchase order number, date, quantity description, account to be charged, value, total, name and title of person authorizing purchase, name and title of person receiving goods. The data was received. This is an example of the form here. Okay, so the statement of accounts. Now a statement of account records transactions with a customer or supplier over a period of time, such as 1 month, 2 months, or 3 months. It shows the opening balance, the invoice numbers, the amounts owed, payments made, credit notes, closing balance. Purpose of the statement of account: it helps the business and the customer to know what is owed at the beginning of the period, what goods were bought during the period, what payments were made, what the balance is at the end of the period. For example, this is what it looks like. A stock card is used to record how much stock a business has. It tracks the stock entering the business, the stock leaving the business, the balance of stock remaining. So the 5 main columns you will find will be the date, reference, stock in, stock out, balance. It might also show things like the quantity, cost, and the value. To calculate the stock value, you will have to do quantity times quantity multiplied by cost, which would equal to the value. For example, if you have 50 items bought at $10 each, 50 by 10 equals $500. This is what your stock card will look like. So the meaning of insurance. Insurance is the process of transferring risk from one party, called the insured, to another party, called the insurer, in exchange for a price called a premium. Insurance provides compensation for loss or damage caused by certain events. Examples of events include fire, flood, theft, injury, accidents. Insurance and risk. Insurance is based on probability. This means it deals with the chance that something may happen. Assurance, however, is based on certainty. For example, insurance may cover that fire damage which may or may not happen. Life assurance is connected to death, which will definitely happen eventually. Okay, an insurance contract is an agreement between the insurer and the insured. An insured pays premiums in exchange for cover. The insurer promises guaranteed payments if there is a loss, subject to the terms of the contract. Main principles of insurance. The major principles are pooling of risks, subrogation, proximate cause, indemnity, utmost good faith, contribution, insurable interests. Pooling of risks means many policyholders pay premiums into one pool of money. When one person suffers a loss, the insurance company pays compensation from the pool. Most people who pay premiums will not make a claim in a given year. Therefore, the money collected from many people can be used to pay the few who suffer a loss. This works because it helps the insurance companies to calculate the likelihood of losses, the amount to charge as premiums, the cost of running the business, and the profit they expect to make. Reinsurance. The insurance companies may share very large risks with other insurance companies. This is called reinsurance. Subrogation means to take the place of. So in insurance, subrogation means that after the insurer pays compensation, the insurer takes over the rights to the damaged or recovered property. Proximate cause means the original or main event that caused the loss. An insurance company only pays if the proximate cause is covered by the policy. Indemnity means putting a person back into the financial position they were in before the loss. Purpose of indemnity. The purpose is to calculate fair compensation. It is easy to apply to losses such as theft, fire damage, property damage. If someone is injured at work, indemnity may consider how long the person is out of work, the current wage, how the accident affects the other parts of their life, and whether the person's negligence contributed to the accident. Utmost good faith means all parties in an insurance contract must be completely honest. The insured must disclose all important information that may affect the insurer's decision. When applying for motor insurance, a customer must tell the insurance company whether they have infringements on their driver's license, whether they have been involved in previous accidents, any information affecting risk. Contribution means that a person cannot claim multiple times for the same loss from different insurance companies. If several insurance companies cover the same risk, they may share the cost of compensation. Insurable interest means a person can only insure something if they would suffer personal economic loss if it were damaged, destroyed, or lost. Examples of insurable interest would be their own life, property, business, factory. A stranger cannot have insurable interest in another person's life. We have various types of insurance policies: life insurance and non-life insurance. Life insurance, there are three main types of that: term policy, whole life or permanent policy, endowment. Term policy pays out if that occurs during the term of the policy, whether the term might be 1 year, 10 years, 30 years. A level term policy pays the same death benefit throughout the policy. A reducing term policy pays less money the longer the policy is held. A whole life or permanent policy. This pays out whenever the person dies, regardless of how long they live. The death benefit and premiums usually stay the same. Endowment policy. An endowment policy pays a lump sum after a specific term on the death of a policyholder. Some endowment policies also pay out if the person becomes critically ill. Non-life insurance policies. Non-life insurance policies are especially important for businesses. The size of the premium depends on likelihood of risk, amount of compensation that may be paid, type of business, and safety precautions in place. Main types of non-life insurance: buildings, fire, and equipment insurance. This protects a business against loss or damage to buildings and equipment. If an insured event occurs, compensation may help the business repair, rebuild, buy new equipment. Product liability insurance. This protects a business against harm caused by one of its products. Fidelity insurance. This covers harm caused by dishonesty or fraud committed by employees. Vehicle insurance. This insures company vehicles and drivers against damage caused by accidents. A company can claim if vehicles are properly serviced, vehicles are properly used, drivers are trained and competent, vehicles are taxed, vehicles are roadworthy. Marine and aviation insurance is similar to vehicle insurance but applies to cargo, freight, airplanes, ships, related marine and aviation equipment. Employer's liability insurance. This covers accidents to employees on company premises or while carrying out the company business. The company may claim if it has taken proper safety steps such as health and safety risk measures, adequate training, safe working conditions. Public liability insurance. This covers accidents or injuries caused by members of the public where the company has done what it reasonably can to prevent harm. Example: a member of the public trips and injures himself on company premises. Public liability insurance may cover damages owed to that person. Cyber and digital risks insurance. This covers businesses' losses caused by cyber attacks on company data. Cyber attacks have become a major cause of business loss in recent years. Businesses may be covered if they have put checks in place such as firewalls, cybersecurity systems, computer specialists, proper data protection measures. Insurance helps businesses and trade because it reduces risk. Business is naturally risky because profit is not guaranteed. However, insurance protects businesses from certain losses, making them more willing to trade. Insurance does not cover every risk. A company cannot insure against not making a profit. Insurance can protect against certain events that cause loss like theft, accident, damage to goods. How insurance encourages trade. It reduces the fear of financial loss, protects goods from whilst being transported, helps businesses recover after disasters, makes exporters more confident, allows firms to continue trading after unexpected events. Airlines and shipping lines can insure fleets by taking out aircraft insurance or marine insurance. When goods are traded internationally, a company can take out freight insurance. If goods are lost or damaged during transport, the company can claim compensation. Protection against disasters. Insurance also protects against fires, accidents, employee injuries, damage to property. Trade credit insurance. Trade credit insurance helps exporters who sell goods on credit to foreign buyers. How trade credit insurance works: the exporter pays a premium to the insurer. The exporter sells goods on credit to a foreign buyer. The exporter waits for payment according to the transaction terms. If the buyer fails to pay within a set time, often 180 days, the insurer compensates the exporter for a percentage of the sale price, such as 75%. Trade credit insurance is beneficial as a country sells more exports and earns more foreign currency. Exporters face less risks. Exporters are more likely to make a return on exports. Exporters' earnings become more predictable. Exporters may be more willing to sell on credit, and businesses can trade internationally with greater confidence. Alright, and that takes us to the end of our video. Thank you all for watching.